Good morning, traders. Welcome to a new week. For those of you who have not seen the video that I posted on Friday, we're effectively trying to turn $10 into $10,000 based on solid fundamental analysis, technical analysis, as well as risk management strategies that we can implement in leverage crypto trading. My background is mainly investment banking for about 20 years, and I've been trading a lot of derivative products throughout my career. So I just realized it's very applicable to the crypto asset class. One thing that I have noticed that there's many gurus out there who kind of relay information that is not very well thought out. I think they prefer to be called gurus rather than actually being gurus. And so I thought I'd put this out free of charge. And whoever wants to follow, follow. Excellent. If you want to subscribe, subscribe. If you don't, no worries. This is purely for your own benefit. So take what you can if you want to, and dismiss the rest. So without further ado, what we normally do is go through the fundamentals at the beginning every week. What we're looking to try and identify are key economic releases that will have an impact on the asset class that we are trading. Now, here's a chart from last week. It's just a daily chart. We will go through this in a second, and I'll update you on where we stand from last week's short BTC position that we take. And but for now, let's pop onto the other channel. Now, this is the Financial Juice. Essentially, what it is it's a market data service. It is free. I've got the elite version. What they do is they offer real-time economic releases and a whole lot of channels consolidating into one area. And this is absolutely essential if you want to identify volatility on the markets before it happens. Now, what we'll do is at the start of the week, we'll go through each of the economic releases that happen, and well, at least the ones that matter. And then we'll see if there's anything coming up in the week that the markets will be aligning themselves to or preparing for. And then we can know when to trade it and when to either be in or out of the markets, when to protect ourselves, and when to how to structure our strategies around that. So today there's not much going on except for the US China trade talks. That's happening all day. This is something where you look at the news and you can expect some kind of announcements. Donald Trump or Xi Jinping, they might say, okay, fine, we've eased tariffs, or we've done something, all right? This might have a fundamental effect. So it's something where it's not scheduled, there's no specific time involved, but it's something just to be aware of, that you may or may not expect an announcement that could have some kind of a market impact, but we don't know the time of that. It may or may not happen. So let's move forward. Over here, we can see more red dots over here. These are high market moving events. This is all UK unemployment. Now, we're not going to really be dealing with the European markets too much. Reason being is because the cryptocurrency tends to be more influenced by the US equities markets than anything else. And as I explained on Friday, this is because a lot of the portfolio managers, traders, they're holding a lot of Bitcoin on their portfolios. And the way they monitor risk is securities that have a high beta, which means the ones that react very violently to the news. This could be because of lack of liquidity. It could be multiple things. But either way, the beta is how sensitive it is to economic news. So if there's anything negative that comes out, you obviously want to drop the securities that are more sensitive than others. And therefore, because they're holding on their books, and if there is any negative news, they will drop Bitcoin or cryptocurrencies a lot sooner than the rest, and well, they don't want to be exposed to that. So this is where the correlation comes in between the US equities market and cryptocurrency. And then obviously if it impacts Bitcoin that everyone's holding, then it has this knock-on effect to Ethereum and your altcoins. So we keep on going down. We see Germans you. Economic sentiment, fine. Canadian, CPI. Okay, CPI is a big thing. We want to keep an eye on inflation. But again, that's Canada, not America. US retail sales, that could have an impact. This tells you the health of the retail market, obviously, and the sales. The more retail sales there are, there's obviously more money is being in circulation. There's more liquidity in the markets and so forth, and people are feeling more optimistic. They're not saving. They're not keeping their cash in their savings accounts, and they spending it, which obviously is very supportive of the economy. So this could be a good thing. More retail sales mean more people are earning money, more people are spending money, and that's a healthy sign. So we'll be keeping an eye on that. US industrial production, again, this is great. This will obviously impact your GDP. And so again, what we're trying to ascertain is which figures are going to have an impact on the interest rates. Okay, so effectively, whatever impacts the interest rates will likely impact the market itself. And the way this works is that if interest rates go down, that means that investment becomes more affordable into certain projects, and then people, borrowing becomes a lot cheaper, and so you'll go forward with projects that will now employ a painter and a builder and architect and whoever. And if they're working, well, then they can spend money at the butcher, baker, and candlestick maker, right? And if they're spending money there, well, then those guys get to spend more. And so it lubricates the economy. The downside is that it also creates a lot of inflation, right? So if you have a lot of inflation, it means that you can't really lower interest rates that much, because then you get just runaway inflation. Quantitative easing really increases inflation, so it's not a good thing to do that. But it's very market supportive, right? So it means that everyone's going to be earning more, but also things are going to become more expensive as well. So we're effectively looking for signs that we're going to be increasing the liquidity in the market. We're going to be increasing, manufacturing and all that stuff, and spending and a healthy economy by lowering interest rates. But the thing is that we are expecting inflation on the back of that. So, this is not going to be an economics course, but just so you have a brief idea of what we're kind of looking at. Again, UK, Eurozone, CPI. Again, these are big numbers. These are going to really impact the foreign exchange markets, but not too much cryptocurrency, that much. Bank of Canada rate decision, EIA crude oil inventories. Again, that's not going to impact us. But here's the big thing, FOMC rate statement. US interest rate decision. These are going to be very, very big. Now, over here, you can see that the forecast is 4.25 and the previous is 4.5. So they are expecting interest rates to be lowered, right, which is market supportive. Now, what's going to happen is people aren't going to trade it on the number that gets released unless it's a big miss than it was, right? So if these figures come out to be 4.5, instead of 4.25, well, then the markets will adjust to that. So that being said, that's when you'll have some volatility on the markets that we need to be aware of. What will normally happen is that the technicals on cryptocurrency will be aligned in a certain direction, all right? And we'll get onto that later on. And it's normally the volatility from the fundamentals that blast us through certain key support resistance levels and so forth, right? So, or give us confirmation and all that stuff. So this is going to be very important to watch. Just remember, it's the expectation of a interest rate decision that people trade on, not necessarily the event itself. So if you are looking at the interest rate decision, fine, they'll bring it out. You'll notice the markets don't move that much, but it's the discussions or the news conferences that happen after it, when they start speaking to Powell, the health of the economy, and how the employment rates are doing, and all that good stuff. When he starts making comments of how he feels about the health of the economy, then traders will start aligning themselves to expectations later on. And that's what actually move the markets based on what he's saying, not what's already happened, because now they're looking forward to the next interest rate decision. So that's the big one. You can expect a lot of volatility, and that will be on, I believe it's Wednesday. I think it's Wednesday, yeah. And then we keep on going down. over here, BOE rate decision, Bank of England. Yeah, so these are big market movers, but I would be trading sterling yen. Don't worry about that in terms of cryptocurrency. And we're keeping our BOJ rate decisions. So you got a lot of rate decisions this week, which will have an impact on the market. So that's the fundamentals. We can expect a lot of volatility going into, after Wednesday evening. And the markets tend to stay a little bit muted going into Wednesday, just because people don't want to take in a big position before there's a shock on Wednesday when the FOMC make an announcement. So now let's go back to the technicals. From our video on Friday, and my own little disclaimer here, it is the first video I've ever made on YouTube, like ever. So if there were a few mistakes in terms of grammar, and I wasn't saying things referring to a rectangle as a triangle and all the rest of it, well, please forgive me, but I hope the message was still taken away. What I was trying to say in terms of trading and technical analysis was still valid. So let's just dive in, a little quick recap. Over here, we're making our way up in Bitcoin, which is great. And as we go through these different kind of resistance and support levels, we go there, we go up, come down, retest support, hit resistance, down, bounce off support, bounce through resistance, that's now support, and we keep on going up. And we've got this diagonal trending line. And what's really nice about these diagonals is that it'll help us to get into positions with and reduce the risk of our exposure. And I'll explain how we actually do that later on, or at least I do it. So we're making our way up. Another thing to mention, we got these different timing bands. Every 220 days, we have a little flush in the market. The next one's going to be around about here. Let me see if 220 days from here, and we're looking at about there. That's actually, so this should be, this little thing here should actually be about there. Okay, so we should expect some kind of downward movements round about here. The problem is that we're getting a little bit close to this diagonal. So if there's a downward movement and it does pierce through this ascending support line, well, that could be interesting. I would think at that point in time, we would probably go sideways while funds go from Bitcoin into your other altcoins. So what we were looking at is a short BTC position. Now, the reason why we took a short BTC position, because we are looking for a little bit of a sell-off going into this window over here. And also we're thinking this is a ABC correction that I explained in last week's video, according to Elliott wave theory. But what was more interesting is if we take this Fibonacci retracement, if we go from the top down to where we came down, we'll notice that this trend line here, that kind of line where it was bouncing off these little lines here, was exactly on the 50% Fibonacci retracement. So the way the ABC works, it goes down, goes up half, 50%, and then it does the next leg, which is the same as that distance. That's your ABC correction before it reverses and then goes higher. So it was exactly at the 50%. So we're kind of happy with that, but you do get false breakouts. Now, let me bring this up. This is on the daily chart, and it's good to keep it on a daily just to simplify matters. But let's have a look at how we know when it's a false breakout and when it's not. Now, this is just my method that I use. If you guys have a different method, go for it, but I will just share mine. Okay, I'm going down to a 4-hour chart. What I do is I take the bottom of these little wicks here. You see there's a wick there, there's a wick there, and there's a wick there. What I'm going to do is I'm going to take there and I'm going to go like that. Okay, so you got a bit of a line there. You got there. You can see where that descending support line is. And then what I do is I copy that. I clone that. And I take it to the top of that line there, which means that if we're going down in a channel, then that would be the top of the channel, right? Now, this works best when you've got the resistance that falls in line with the horizontal resistance and support level. So if we look over here, we got a little bit of we reversed over here, and that also happens to be in line with the kind of the bottom of these wicks over here. So let's just draw. I mean, these are support and resistance lines, but like kind of intermediate ones. They're not that important, but you can see that there was a bit of resistance there. We bounced off there. We bounced off there. All these little wicks that go over there, and they kept on hitting the same point. So it's something we can't really ignore, but something we don't want to get too excited about. But what that tells me is if we look here, you got the descending resistance, and it coincides with here. So I would say that it could kind of go up and touch that and then go down again if it does go above this line. Because what we had here are these false breakouts. You can see one happened last night. And the big question is, Alan, when do you know when a false breakout is actually a change in trend? It's not a false breakout. First of all, the definition really of or at least a good explanation of a false breakout is when it goes up above that resistance or support line, and it doesn't close above it. It comes back down again. It basically tries to flush everyone out and then comes all the way back down, because that wick over here, it may look nice and green and was really high, but for it to get all the way back here, everyone had to sell into that, right? So let's go on to the daily over here. I mean, look at that wick. Okay, look at that wick. It came down like that, went all the way up, but then it sold all the way down again. I mean, that's from the top to where it is now. That's just under 2%. Now, that just under 2% may not seem like a lot for crypto, but for Bitcoin, it's starting to be a decent move. And it's because the market cap of Bitcoin is getting so large that it takes huge amounts of capital to swing the markets back and forth, right? So we got a nice little breakout. So if we have these things called false breakouts, where do you put your stop losses and how much leverage you take, right? So as you can see over here, this is where I got into the position about here. And to be fair, I mean, okay, I'm going to go in complete honesty. What happened was it went up. I was meant to take a position there because I was meant to have a limit order to go there, but then I didn't have one. And then the next morning I woke up, I saw it was a false breakout, and so I actually took it a little bit further down, okay? So it's not the optimal place. I should have actually taken it at that line. Should have had a limit order there, but I didn't, but it is what it is. So now what I should have done, well, this is how you kind of approach this. If you're on this line, what we should have done, if you go up to where that descending line was, you know, that one that we just had now, so that's about like a 2.5% move, okay? Let's go back to the 4-hour chart. See that line that we drew there? That's a top. There's a support resistance there. Plus you got the top of this line as well. So you can have this situation where it can go up, go through, touch there, touch the top of this one. It can touch the top of that one. It does a little bit of a false breakout. But as we keep on going with time, if we keep on going along into the end of September, that line's coming down, 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 which means that the amount we were going to risk comes down, 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 because our stop loss needs to be on the other side of this descending resistance. So let's have a look here. Hypothetically speaking, we take it right. Let's say we got in at that line, and it's 2.5% away, right? Means that the most amount of leverage you can put on that would probably be about 40 times. Now, please don't think that I'm saying you have to take 40 times leverage. That is a very, very, very large amount. But the point I'm trying to make is that you need to be aware of the impact of leverage. If you took that position and you were all in on 40 times leverage, it'll actually liquidate you a little bit before then, because there's liquidation costs involved. And that means that it'll just take everything. It'll wipe out your entire account. Okay, so it's something you want to, you really need to be aware of this. Trading leverage is very dangerous, but it can be managed. So let's just say on this scenario, instead of going 40 times leverage, let's go 20 times leverage. So if we go, means that we can withhold, we can stand a 4% drop. Okay, so it'll mean that we'll get liquidated at this level. Now, again, I'm not saying you should trade with these high amounts, but what I am saying is that your stop loss needs to be way before them. Okay, so if you are going 20 times leverage on that point, be aware that on 40 if you're going 20 times leverage, be aware that at 5%, round about there, that is your liquidation level. When you lose everything, okay, you need to put your stop around about there. Okay, so just something that needs to be kept in mind. So we go up, we come down. That is my invalidation. This my invalidation level is coming down over here. When I'm taking a short position, there's a few things that I'll be looking for. One is that as it's coming down, it can bounce. Now we're on the 4-hour chart now. This yellow line is the 200-day. The 200-day is about to hit the bottom line there, which is why I've decided to put in order to close my position over here. Now this comes to the second point I'm trying to make. Okay, that's very, very important. We will probably close the position here. On confirmation that we're going through it, we'll pick up the position again. Okay. If it bounces, we'll get confirmation of that bounce and that this line, this ascending line is respecting and it still wants to go up, maybe hit its head on that, retest that, and then go lower. If it goes lower at all, remember, it can also blast all the way through. But what we're saying is that right now there's a rising support that's going to coincide with the 200-day moving average. And that 200-day moving average over here, that level is also there. It knocked on there. This all adds to the support and resistance, right? So we close that. Now, what we're not going to do, we're not going to add to this position because right now we have a short position of 0.005 of a Bitcoin, right? And we've made $2.64. Now you may be thinking, Alan, yeah, it's $2.64. I'm not getting excited that at all. That does not make me that excited at all. And well, you're right. The problem is that that's 26%. Okay, so we've made 26.5% on the $10 because we leverage. By the time it gets down to this point here, that's probably going to be closer to $10, and we've just doubled our money on a little pullback of say 2%. So then when we change direction, again, we do not add to that position because if we go and close our position, then switch this to a long position at twice the amount because now we've just made double the amount, right? So we add to this. So it's now 0.01 instead of 0.005. It means it only has to bounce half that amount. And we've wiped out everything that we earned on the way back down because we exposed twice as much. Now, I will be sending another video on how to enter a position like this so that you don't burn yourself up or blow up your account. Very high, from a higher level perspective. You come down, you take a position in the opposite position, or if you wanted to get the bounce and you think it's going to go up along this trending line, you'll close your position at the 200-day moving average. You'll go from short to long at 0.005. If we've made, triple our money or whatever it was on the way down, and we want to actually increase our position size, we don't do it on the first trade. We'll go down. Let's go down to the 5-hour chart, right? Let's say we're going down here. This is a 5-minute chart. If this comes down here, it's going to bounce off that level. And it's going to keep on respecting that level. And as we keep on going forward in time, it lifts up. It kind of lifts it up. So if we got in at that level, by the time like a few hours later, our entry is down here and the support's up there, which means that we can now take our second position over here. We can double up on our position up here, which means our average price is halfway between our original entry and our new entry because we averaged in, right? But it's still below the support line. So if the support line does break and it decides to go down and invalidates this upward trend, we have time to get out of it with a profit, even though we were wrong. So this is very important when it comes down to how you trade, and not necessarily are you getting the direction right, because you can get the direction right 70 or 80% of the time and you could still lose money if you're not trading correctly. But the flip side is too, you could actually get, call the wrong direction. But if you trade correctly, and if you have correct risk management, and if you have a certain technique, you could actually still make money even though you got the wrong direction. And that is because you can be wrong, like I've just showed you. You could still actually get out with a profit if you got the low, went up, averaged into your position, but then it broke the trend line and you got out with a little bit of a profit. So, it's how you trade is actually more important than knowing whether you right or wrong. Now, what we're doing here with leverage, essentially, we don't care if Bitcoin's going to be higher in a month from now or 2 months from now or a year from now. That's what investors do. An investor will go, okay, it's trading now at 114. I think it's going to 160. I'm buying now. And I don't care what happens in between. It can go up, down, sideways, do whatever it wants to do. As long as in a year from now, it's trading higher, I've made a profit. And that's great. It's a lower risk. You're not going to be liquidated. And it's a far more stress-free. But if you're going to be doing, a 5x or a 10x or whatever it is on your other altcoins, well, that's fine. That's all you'll get out. We are trying to make as much as we can from as little as $10 up to $10,000. You're not going to be able to do that without a knowing, being very, very, very lucky on picking some gem that has a very low market cap and it suddenly does 1,000x. And that's great. And it does happen. It's just very unlikely it's going to happen. So this way, at least we're trying to apply certain trading techniques so that we can slowly but gradually get to a higher account value. So we're not looking necessarily for whether the market's going up and down. We're looking for trends. The market can go up, we go long. Market goes down, we go short. But it's all about probabilities. It's all about finding the trend and maximizing our reward versus our risk that we're taking in order to take that trade. So I'm going to leave it at that in terms of where we are. Again, we are now turning the market down. Yeah, I'm going to close it if we get down to the 200-day moving average. If we go through this line over here, I would say that the bear flag that I mentioned last week, then it's been validated. And then we can pick up the trade afterwards. We're not going to lose that much because we'll pick it up on the way down, but we're going to be going in at the same amount. So that's absolutely crucial. Do not increase your position size, even though your account is larger. So you will be taking a smaller percentage of your overall account size, but you will be matching your previous exposure 1-for-1. It's only later on when you have confirmation of your trade, when you've now definitely have a high account balance, that you can lift up or increase the amount or your notional position size. One thing I want to just have a look here. Let's look at our other altcoins, just a few other ones. Again, okay, so this is GRT. It's coming down a little bit. You can see it's going to come down, maybe hit the bottom of this rising support, maybe wick down onto this support level and then go through. What we're doing is we're looking to buy on the support levels. Most of these altcoins are all kind of doing in ascending triangles. Let me show you here. I mean, that looks like actually a very good place to buy, to be fair. That would be a very nice way to buy. I'm just a little bit concerned that BTC has got this wick, which is a reversal pattern. If it breaks down there, it might drag radium through that lower support and test the 200-day moving average. So just kind of holding off on that one. Drifted very well. As you can see on drift, I've kind of created this triangle just to show what I what I'm meaning, what happens is it goes down, you know, all the sellers push down the market price, goes up, hits its head on the resistance, comes back down again, but doesn't go past these levels here, right? Doesn't go thinking. So it goes up, once again, gets rejected at the resistance, comes down, but doesn't come down as much as previously. So you got the buying pressure is staying the same, but the selling pressure is becoming a little bit less, until it gets to this critical mass and then it blasts through. So what we're looking for, we're either looking for a retest of this rising support, or we're looking for it to blast through the support, hit the next resistance, come down, retest the resistance turn support, and then bounce off. Either way, we're taking a position. But we want to try and get it as low as possible. Because we're trading leverage, we really want to take the positions at the key areas. If you're just investing, well, you can pretty much buy anywhere as long as you know that it's going to be higher later on. But the optimal position, I think, would be down there, right? Now, what you might have, if we look at Bitcoin dominance, is that it's got this downward trend, which means that Bitcoin is going down compared to all the other altcoins. So if we look at, say, Radium, for example, you may have a scenario where Bitcoin's going down and it's staying the same here. If Bitcoin goes down and Radium stays where it is and holds that rising support level, then Bitcoin dominance is going down, okay, which it is. So we would expect that if Bitcoin dominance continues to go down and hit this bottom trend line here, if it continues to go down there, we can expect, what it's saying is that Bitcoin's going to fall faster than the altcoins, which means that if that does come down, Bitcoin does come down to about there, graph, Radium, Drift, they're going to come down slower than Bitcoin. And that means that we could still have a situation where these support levels hold even though Bitcoin is falling. Now, as I mentioned in the last video, I don't short altcoins during a bull run. I just don't, because they are prone to these massive spikes. They need far less capital inflows in order to do a 30, 40, 50% move. And if you do a 30, 40, 50% move and you leveraged and you're pointing in the wrong direction, again, it's not really good. So I'm going to get this video out. Hopefully it helps you. Either way, we're still looking short. We're going to cut it potentially when we have a retest of this lower support. If we break through that, we're probably going to go down like this. Let me quickly get the sorry, where is it? Path, yeah. So if it does go through, we'll probably go down there, bounce off there, boom, it could go like that, and then down like that. It could do something like that, right? Okay, or it can go like, or it could just go bounce off there, and go like that, and go like that. Or it could just go like that. I mean, the fact is that it can do all these things. And I know it doesn't help me saying it can either go up or down, but the fact is we know where it's going to go up and down, and we can adjust our risk accordingly. Now, according to this, we're just getting the probability in our favor. I'm going to cut the position over here. If we break through, well, then we go there. I might even take a long position if it bounce off the 200-day moving average over here. So we're on the 4-hour chart, hitting the 200 moving average on the 4-hour chart. If it bounces off there, goes up like that, if it breaks through, well, then we cut that position, we go short. So, well, that's the beginning of the week. Don't forget, FOMC on Wednesday. We can expect some volatility, and all the best. Good luck, traders. Bye.